The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. Now, the year 2025 may be a difficult one to navigate, as policy implementation will be revealed that is likely to result in twists and turns for the markets. The evolution of economic fundamentals and the impact of policy changes on them will continue to be crucial. Now, without a doubt, the changes implemented by the incoming U.S. administration will clearly have a major impact on markets, but it is also important to note that fiscal plans in Europe, UK, and China will play a big part in shaping the overall economic cycle and strategies of central banks. So going into the new year, what do investors of fixed income markets need to be aware of? Well, to find out more, joining me now is Kheng Siang, who is the Asia Pacific head of fixed income at State Street Global Advisor. Kheng Siang, welcome to the show.
Thank you.
Thank you so much for joining me. Okay, Kheng Siang, just to give a little recap here, how did fixed income markets fare back in 2024?
Yeah, fixed income markets had, I would say, a bit of a roller coaster ride. We had the start of the year where the market was, not expecting much of a Fed cut, but then soon at the middle of the year, the Fed delivered the cut, and the market was very aggressively pricing for more cuts until towards the end of the year came back down in terms of the expectations of more rate cuts. So I think fixed income had a bit of a roller coaster ride. That's on the rates front. On the credit front, we have seen the credit spreads continue to compress. So that has been a positive contribution for return. So I would say that it depends on selective sectors within the fixed income. They do have a mixed performance. But one thing is notable is the dollar strength that has been affecting the total returns of the emerging market bonds in particular.
I see. You know, a dominant theme for fixed income markets this year, 2025, will be where U.S. interest rates find themselves at the end of this, rate cycle. So, Kheng Siang, what may be in store for Fed policy in 2025?
I would think that given what has been communicated by the Fed Chairman Powell recently in December, the market should be expecting that the Fed should slow down its pace of rate cuts and assess where they are in terms of the data. Of course, we know that the recent data has been on the more upbeat tone. That has been something that the Fed is watching very closely, and they want to avoid to cut rates too much, too fast. At the same time, we also have the U.S. new president coming in about 1-2 weeks' time. That itself would also mean that the policy of the U.S. administration may change, in particular with regards to fiscal spending as well as the tariffs. So that is complicating the matter for the Fed. So I think the Fed will be a little bit more cautious for the rate moves in this year. Perhaps maybe the next few months they could be pausing and kind of wait for the policies to be a little bit more transparent when the new president comes into office.
I see. So given the predicted path, how will this impact fixed income markets this year? What should investors expect?
We think that the fixed income markets for the first maybe 1-2 months of this year will still be in a mode whereby it's trading sideways a little bit, and some concerns in terms of that policy uncertainty coming from the U.S. and what are the announcements that could be made by the U.S. president. So that itself is creating some volatility in the fixed income market. But at the same time, in the case of U.S., there's also a development that is worth noting, which is the U.S. debt ceiling limit. And we are getting very close to that limit, so that is also creating concern. Hence, we have seen the U.S. bond yield curve steepening up with the long end part of the curve underperforming. So that's kind of where we see in terms of the U.S. market. But elsewhere in the other markets, for instance, in Asia, we'll be expecting that the Asian central banks to be more careful in terms of when they think they're going to be cutting policy rates. A number of Asian countries are expecting slower growth, and they feel they need to lower interest rates. But at the moment, what is not working in their favor is the strong dollar or the weak Asian currencies. So that's something causing the local fixed income market to so-called underperform as well. So I think investors should expect this year, at least for the start of the year, the market could be more uncertain, more sideways. Towards the middle part of the year, we may see potentially a clearer picture on how the fixed income market will fare.
I see. Well, then how can investors use bond ETFs to, position fixed income portfolios to potentially benefit from the Fed's expected path?
Well, ETF is a very powerful tool in terms of implementing your investment strategy. So for investors in the fixed income world, the ETF itself would give you a very quick way to express your view and implement that trade through the ETF creation or redemption. So therefore, investors would find that the use of ETFs would help them to execute at a lower transaction cost. So that's a very important aspect that I think investors would be using. Apart from just trading bond futures, but the ETFs on fixed income give you a basket of securities that can be traded at just one go.
I see. Well, regardless of the path of Fed policy in 2025, Siang, are there any other ways investors can position their fixed income portfolios?
We think that the current weakness in the fixed income market, especially in the case of US, would be good opportunities for investors or clients to slowly build up positions in the bond. We feel that the government bonds are likely to outperform this year. Given where the rates or the levels are at the moment, and our expectations that the Fed will still be cutting rates towards the later part of the year, even though the magnitude of rate cuts would be less. So again, I think fixed income at the front end part of the curve especially will be very interesting when we feel that there will be value there for investors. So in case of the emerging markets in Asia, we feel that at this point in time, it is likely to underperform given the strong dollar that we expect for most part of this year. So therefore, the emerging markets, we feel the hard currency emerging market bonds will likely be more favorable for investors going forward.
I see. Well, then how do you see inflation trends playing out through 2025? Do you think we'll see sustained inflationary pressure, or do you anticipate inflation will be under control by this year?
It's a very mixed picture in terms of inflation trends. If you look at the U.S., the inflationary pressures may increase given what the Trump president, or not yet president-to-be, has been saying during his election campaign. Right? So if tariffs are implemented, that would likely mean that the U.S. prices, the imported prices, will increase for the items. Unless U.S. has the way to substitute import goods with domestic production, which in short term that can be done. So it would likely lead to high inflation. Also, the other point is if the incoming president would decide to expand fiscal spending, as he had indicated, and if that's done, that would also likely to be inflationary as well. So I think U.S. near term, the risk for high inflation is very real. Elsewhere, in other parts of the market, we are seeing slowdown in growth. In some countries, for instance, we are seeing very low inflation. China in particular, whereby the growth hasn't been that strong, in fact, rather weak, the inflationary situation is on the reverse. So that's more concern that it may be falling into deflation.
I see. Well, then given current economic growth projections, do you see or do you believe the fixed income market will favor long-term or short-term bonds in 2025?
Yeah, given the dynamics and the factors that's kind of playing out in the market, we feel the short end part of the fixed income market will likely be doing better. That's mainly because the expectations of the curve steepening will happen given the uncertainty around that, especially for the case of U.S. And the higher U.S. bond yields would also affect the general sentiment for other fixed income market as well, as the higher U.S. bond yields may attract investors or capital flows into U.S., thereby suppressing the performance or the attractions of the other markets.
I see. Then what is your outlook for market liquidity this year? Will the fixed income market experience any challenges in terms of liquidity, especially in high-yield bonds?
I would think that in general, liquidity shouldn't be a main concern for us, as we think that the fixed income market has been behaving well. I mean, there's a deep pool of liquidity and players around that, so there shouldn't be an issue. Having said that, there's also, given the U.S. debt ceiling issue looming, there could be potential shocks, as we have witnessed during the COVID period as well, that the U.S. Treasuries had also very unexpectedly facing some liquidity challenges. In terms of the high yield market that you allude to, we think that given the valuation of the spread compressions currently at this stage, it is rather stretched at the moment, and investors may feel that the additional payoffs investing in high yield is not that obvious. So I think from that front, potentially the trading volume may start to slow down a little bit. That might have some impact on the liquidity part, but we do not expect any significant deterioration in that liquidity.
I see. Then how do you expect investor sentiment towards, riskier assets like junk bonds and emerging market debt to evolve this year?
I think investors in general perhaps will likely be more cautious, especially given the uncertainty. So when it comes to positioning for riskier assets, such as junk bonds or emerging market debt, we think that they would be taking a more cautious approach. On the junk bond side, because it is high yield, in the current uncertainty and potentially a slowdown in general, apart from U.S., credit fundamentals may be somewhat worsening slightly, or put it the other way, is not as strong as it was before, not that it's really very weak. So from that standpoint, the lower grades of credit of bonds may potentially likely to experience a bit of a weakness. And in terms of name selection becomes very important, especially with the junk bonds at current levels. In the emerging market space, as I pointed out earlier, the local currency fixed income space will be a bit more challenging, mainly principally due to the currency aspect, whereby a strong dollar will likely create a negative total return. Just on the local market return-wise, the fixed income market will likely remain reasonably steady for most of the markets. So I think if you just sum it up, even for EM this year, we feel that the hard currency market for EM will likely do better than the local currency emerging market bonds.
I see. Then what strategies would you recommend to bond investors looking to navigate the fixed income market in 2025?
The main themes this year that we are saying to investors is go long the government bonds or the risk-free bonds. We feel that, in terms of central banks, more likely they will still cut rates, even though it may not be as much as before. And that potentially would offer a lot of opportunities. If you look at, for instance, in the U.S. government, 4+ percentage in terms of yield itself is very attractive. Credit space, we have seen a tightening of spreads over the last 1 year. And to a large extent, the tight valuation may not offer much of a upside for this year. So I think from our point of view, we feel the potential there is not as great. And then in terms of within the credit space, we prefer the investment grade or higher quality credit than a lower quality credit, given the current cycle, whereby in general we're expecting a bit of slowdown. So therefore, this area will likely lead to a better performance in the investment grade credit. The other recommendations that we are kind of looking at is on the emerging market front, which is, overweight the hard currency market, given its expectations that it will perform better in total returns, whereas the local currency may still be hit by the negative foreign currency return.
I see. So what sectors or asset classes within the fixed income market do you think will perform well in 2025, and which ones should investors avoid?
Well, we think this year, as mentioned, maybe more the government bond side, they would likely do better. And within the credit, the investment grade credit. I think at this stage of where the bond levels are trading, investors need to be more selective in terms of the investors' positioning and emphasize quality a little bit more, given the uncertainty, as the heightened volatility spike may potentially create some downside performance. So I think that's where we are seeing. Of course, within the fixed income market sector, as you prefer rates over credit, I think that will be a theme that will continue to play out.
I see. Well, thank you so much, Siang, for your time and your insights today.
Thank you.
Thank you. That was Siang, who is the Asia Pacific head of fixed income at State Street Global Advisors. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.